This move isn't emotion, it's math. And the math says global liquidity just found a new exit route through gold and silver. The conflict is obvious. The loudest voices will insist it's just geopolitics or just fear, because that explanation is tidy and controllable. But the hidden mechanism is uglier and more powerful. Liquidity doesn't leave the system in a straight line. It sloshes, it bottlenecks, and when it hits the wrong pipes at the wrong time, precious metals don't just rise, they absorb shock. And if you stay with me, I'm going to give you the exact checklist for the next week or two. What levels matter? What would confirm this is still live? What would invalidate it? And what kind of volatility trap is most likely to be used to shake you out right before the next leg? Start with the tape, because the tape is the confession. As of January 15th, spot gold is sitting around the mid-4,600s after printing a fresh record the prior day near $4,643, and then pulling back on profit taking. Silver just did what silver does. It ripped through the $90 handle, flirted with the low 90s, and then snapped lower in a single breath, trading in the high 80s with a drop that feels violent if you're not prepared for it. That's not a bug. That's the market showing you where liquidity is thin. That's the market showing you where forced decisions live. And that's where the real pressure starts. Because here's what everyone gets wrong in real time. They treat a pullback after a record high like a verdict. It's not a verdict. It's a stress test. The question isn't, did it dip? The question is, who was forced to do what because it dipped? And the next detail is what flips the whole setup. Gold and silver aren't just assets right now. They're functioning as clearance mechanisms for anxiety about currency, policy credibility, and cross-border settlement. That's why you're seeing synchronized strength across multiple metals at once. Gold, silver, even industrial metals joining the party at record levels. When that happens, it's rarely a single headline. It's usually a system-level bid. It's usually money trying to front-run the next constraint. So let's name the hidden detail plainly. The most underappreciated driver isn't a war headline or a politician's quote. It's the plumbing, the schedule of liquidity additions and subtractions that hit the system before price discovery can calmly process them. Think of it like this. Everybody stares at the thermostat, but the real story is the vents. The vents are where the airflow changes first. In markets, those vents are reserve balances, collateral availability, margin requirements, and the quiet rotation between cash-like instruments and trust-like instruments. And right now, trust is being repriced. If you want a clean mental model, forget the idea that markets are one pool. Markets are a bunch of connected pools with narrow gates between them. When liquidity gets redirected, it doesn't evenly lower the water level everywhere. It drains one pool, floods another, and then people mistake the flood for a trend. But it's the gate that matters. It's the gate that decides who gets to move size without blowing themselves up. Gold and silver are acting like that gate. Now, why do metals absorb the shock when liquidity shifts? Because they sit in a weird sweet spot. They're globally recognized. They're politically neutral compared to any single currency. And they're deeply embedded in collateral logic and reserve behavior. And when institutional players start to worry, not just about returns, but about rules changing, about settlement getting weird, about policy credibility, they don't want a story asset. They want a balance sheet asset. They want something that still clears when confidence becomes the scarce commodity. But that's not the part that matters most. What matters most is how that demand interacts with market structure. Here's where we stop talking vibes and start talking mechanics. Metals pricing is not just spot trading. It's futures curves, roll costs, spreads, inventory categories, delivery windows, and dealer hedging. And the most telling signals don't come from a single price print. They come from the relationship between now and later. They come from the market's willingness to pay for immediate metal versus future delivery. They come from whether the curve is behaving like inventory is plenty or inventory is precious. This is the moment you should lock in one concept. When a market is in calm conditions, the forward price tends to sit above spot because of carry. Storage, insurance, financing, that's normal contango. But when immediate demand tightens, or when metal is being treated like urgent collateral, the curve can flatten or invert. That's backwardation, and it's not a magic word. It's a signal that the market is paying a premium for now, not eventually. And when that happens in a market with leverage and delivery optionality, it can force behaviors that amplify price moves. Because if the curve shifts, the math changes. Let's talk paper versus physical without turning it into a cartoon. You do not need manipulation myths to get paper physical tension. You only need incentives. Futures markets allow hedgers and speculators to take exposure efficiently. That's good. But they also create a world where a lot of metal exposure is really exposure to a contract, not a bar. Most of the time, that's fine because contracts net out. But when stress rises, when more participants want the option of delivery, or when physical tightness grows, or when collateral preference shifts, the convenience of paper starts to be questioned. Not morally questioned, mechanically questioned. And then the market does something brutal. It makes optional decisions expensive. That's why delivery windows matter. That's why calendar matters. When you approach periods where contracts roll, where options expire, where delivery notices concentrate, where funds rebalance into month end, you get forced flows. And forced flows in a thin book are how you get spikes that look irrational until you realize that someone had to act. Now we get to the inventory reality check, the part retail rarely gets told clearly. Not all inventory is the same. In the comics world, you often hear about eligible versus registered. Eligible metal meets standards and sits in approved warehouses, but it isn't committed to satisfy futures delivery unless the owner chooses to convert it. Registered metal is what's actually warranted and available for delivery against contracts. So total inventory can look fine, while deliverable inventory is tight. That's like saying a city has plenty of water because there are lakes nearby, ignoring the fact that the pipelines to the neighborhoods are half shut. The pipeline is registered inventory. The lake is eligible. And when registered gets tight during a period where delivery pressure rises, it doesn't mean there's no metal. It means the metal that matters for this contract is scarce unless someone volunteers it. And if someone has to volunteer it, the price has to persuade them. But here's the twist. Even when there's enough metal in the world, the bottleneck can be logistics and willingness. Refining lead times, transport, bulk capacity, bar forms that match what's demanded, and the simple question of, do I want to part with this inventory now? All become active variables that mess why you can see tightness signals and rising premiums, even if the world is not literally out of metal. Markets aren't about absolute scarcity. They're about marginal availability at the point of settlement. And silver, in particular, is a special kind of chaotic because its supply chain is weird. A lot of silver production is byproduct production, tied to base metal mining cycles. That means you don't just flip a switch and produce more silver because price spiked. You're constrained by copper, lead, zinc economics, by refining capacity, by how fast recycled supply responds, and by the time it takes to move physical metal through a real-world chain. That's why silver can feel calm for years, and then suddenly it behaves like a trapdoor. Now layer in institutional flows, because this is where the rally stops being a chart and starts being a vehicle. ETFs and ETPs can be a bridge between market demand and physical sourcing. When flows turn positive in a regime shift, the vehicle has to do something. It has to create shares, source metal, or adjust hedges. Not instantly, not always directly, but flows change the background bid. And, more importantly, flows change psychology. They tell institutions and allocators that this is investable, that it's liquid enough, that it belongs in the risk management toolbox that matters. At the same time, central bank and sovereign behavior creates another kind of bid, one that doesn't care about your perfect entry. Official buyers don't chase candles. They accumulate through noise. They treat dips as inventory opportunities, not moral judgments about whether the rally is over. And recent demand trend research has shown central banks staying a firm pillar of gold demand, with buying in 2025 running meaningfully above pre-2022 averages. That doesn't guarantee anything in the next week, but it changes what support means in a market where the marginal seller is often a leveraged speculator. And that's where the market gets cruel. Leveraged specs sell because they have to. Official and strategic buyers buy because they can. That transfer is how long violent trends sustain. Now, let S address the big counterpoint before it ambushes you. Isn't this just a blow-off top? Isn't this just fear that will fade? That's a legitimate question, because we just watched gold print a record and then dip. We just watched silver snap lower after running over $90. That's exactly what blow-offs look like. But the way you separate a blow-off from a regime shift is not by arguing about vibes. It's by watching the structure. Here are the 5 proof points you should be stacking, not in isolation, but together, because one signal can lie, but a stack is harder to fake. First, term structure. Does the front of the curve stay firm? Do near-month spreads stay bid? If spot demand is urgent, the curve tends to flatten and spreads can stay tight even when price pulls back. Second, inventory categories. Not total inventory, but deliverable versus non-deliverable buckets, registered versus eligible, especially around delivery windows. If deliverable tightness persists, it keeps pressure on the system. Third, margin and collateral behavior. When an exchange like CME shifts to percentage-based margin methodology and effectively makes positions more expensive as price rises, it is telling you something. Volatility is high enough that the system is defending itself against default risk. That can cause liquidation drops, fast, ugly drops, even in a bull market. But if price absorbs that and reclaims levels, it's a sign the bid is deeper than leverage. Fourth, real-world frictions, premiums, availability, lead times. You don't need sensational shortage claims. You're looking for the subtle symptoms, the small pain that signals bigger pressure. When mints and dealers talk about longer delivery times, or when retail premiums stay sticky despite price pullbacks, it suggests demand is not purely speculative. Fifth, cross-market comparison. Watch the dollar, watch real yields, watch risk assets. If metals are rising while other risk-off assets aren't behaving in the classic way, it suggests this is not just fear. It suggests a broader repricing of monetary credibility and liquidity preference. And here's the part that most people miss. In a liquidity shift, you can get money market fund inflows at the same time as metals ripping. That looks contradictory until you understand it's not risk on versus risk off. It's where can I park and where can I hedge? Cash piles up and hedges get bought. That combination is a signature of uncertainty about what the next rule change will be. Now, let's talk about silver's personality, because it asks the psychological battlefield where most people lose money even when they read directionally right. Silver is not gold with more upside. Silver is a leverage instrument disguised as a commodity. It has industrial demand, monetary demand, and it trades with thinner depth. That means it's more prone to margin cascades. When silver drops 3% or 4% in a day, that's not proof the thesis is dead. That's proof the market has a lot of participants who cannot hold through variance. The market doesn't care about your conviction. It cares about your margin. And that's why the calendar trigger matters right now. The calendar is the catalyst because the market is moving through periods where liquidity and hedging flows get compressed into a smaller number of sessions. Option expiry matters. Dealer positioning matters. If price pushes through certain strikes into expiry windows, dealers who are short calls can be forced to hedge by buying futures, which pushes price up, which increases delta, which forces more buying. That's reflexivity. That's gamma. And you don't need a meme mania for it. You just need the right positioning and the wrong liquidity. Meanwhile, month-end and quarter mechanics can change how funds rebalance. If metals have outperformed, some funds trim. If volatility spikes, risk models reduce exposure. If margins rise, some players de-risk mechanically. That creates a predictable pattern. Sharp pullbacks that feel like betrayal, followed by stabilization and another push if the underlying bid is real. That's why you must separate trend signal from noise. Trend signal is structure holding and spreads staying firm. Noise is wick violence caused by forced selling. And that's exactly where the market will try to manipulate you emotionally, not by conspiracy, but by design. Volatility is a weapon because it forces decisions. It makes you act like you're wrong at the exact moment your thesis is still right. It makes you sell the retest and buy the breakout. It makes you turn a strategic position into a series of reactive mistakes. So here's your viewer psychology shield. And I want you to take it seriously because it's worth more than any price target. First, decide your time horizon before you look at a candle. If your horizon is 2 weeks, you watch weekly structure and key levels. If your horizon is 6 months, you care about regime drivers and structural signals, not daily drama. Second, predefine invalidation, not discomfort. Discomfort is volatility. Invalidation is the market breaking a level and the mechanisms deteriorating at the same time. Third, assume whipsaw. Assume a savage pullback is not only possible but likely, precisely because everyone is watching the same levels. If you're not expecting it, you'll interpret it as information. If you are expecting it, you'll interpret it as a stress test. Now let's get concrete about what comes next, because this is where trust is built. Over the next week or two, watch gold around the $4,600 zone. It's a psychological line and a structural one, a controlled pullback that holds above roughly the mid $4,500 and then reclaims $4,600 would be a classic retest behavior, especially after printing a record. If gold can consolidate and then push back toward the record high zone near $4,640, $4,650, you're looking at a market that absorbed margin pressure and profit taking without breaking the underlying bid. On the downside, a clean break that loses the $4,500 area and can't reclaim it, especially if it's accompanied by calming term structure, easing spreads, and a broader shift back into risk assets, would weaken the liquidity shock absorption thesis in the near term, not permanently, but tactically. That would tell you the market needed a bigger reset. Silver is the faster, sharper version of the same story. The $90 handle is the loud psychological line. Silver reclaiming and holding that area after a pullback would be a meaningful confirmation signal. If it reclaims $90 and pushes back into the low 90s, you should be thinking about the squeeze path to $100 because round numbers are where optionality and psychology concentrate. But if silver loses the mid to high 80s and starts accepting prices below the low 80s, that would suggest the leverage unwind is larger and that you're in a deeper consolidation rather than immediate continuation. But don't miss the nuance. Even a deeper consolidation can be bullish if the structural signals stay tight. That's why you don't watch price alone. You watch the behavior around price. Now, let's lay out the two scenarios clearly, because this is how you keep your head when the market tries to steal it. Scenario 1 is the controlled pullback and retest. Gold chops, maybe dips, but holds structure. Silver whips, flushes late longs, then starts printing higher lows. The curve stays firm. Spreads don't collapse. Physical frictions don't disappear. And the market spends a few sessions building a base while everyone screams that the top is in. This scenario is psychologically difficult because it's boring and violent at the same time. Chop plus wicks. But it's the scenario where disciplined positioning wins. Scenario 2 is the continuation squeeze with gap risk. This is the one where liquidity thins at the wrong moment. Around expiry windows, around a geopolitical spike, around a policy credibility scare, and price jumps levels without giving you a clean entry. Gold rips back into record highs and beyond. Silver snaps through $95 and starts sniffing $100 faster than anyone thinks is reasonable. In this scenario, the risk is not missing out. The risk is chasing a move that's being driven by forced buying and then getting caught in the inevitable margin-driven pullback. This scenario rewards preparation, not impulse. And here's the subtle point that keeps you sane. Both scenarios can be bullish. The difference is the path and the tactics. If you understand that, you stop letting the market narrate your emotions. So what should you watch like a hawk this week? Watch how gold behaves around $4,600, not one print, behavior. Does it get rejected hard and stay rejected, or does it dip and reclaim? Watch silver's relationship with $90. Does it treat it like a ceiling or a magnet? Watch volatility and margin chatter, because if margin methodology changes, make positions more expensive as price rises, you can get sudden liquidations that look like tops. But if those liquidations get bought, that's not weakness. That's a bid revealing itself. Watch the curve and spreads. If you can't access that data directly, watch proxies. Do near-dated contracts stay stubbornly expensive? Do premiums stay sticky? Does retail availability feel tight even when price dips? Those are the street symptoms that often move before the headlines catch up. Watch the macro cross-currents too. If geopolitical risk cools and gold still refuses to give back key levels, it's telling you the bid is not purely fear. If the narrative shifts to rate cuts and gold keeps acting like a collateral asset rather than a simple inflation hedge, that's telling you liquidity preference is changing. And don't ignore the institutional tell. When markets are stressed, the system raises the cost of participation. That's margins. That's collateral. That's funding. If the cost of participation rises and price still holds, that's strength. Now, I need to say something that sounds simple but is rarely practiced. You do not need to predict the next dollar move to make a smart decision. You need to avoid being emotionally harvested by the volatility. The market will try to turn every pullback into a referendum on your intelligence. It will try to turn every headline into a command. And if you let that happen, you would all sell the stress test and buy the confirmation over and over until you re-exhausted and broke. Instead, do this. Treat this as a regime shift hypothesis, not a day trade ego contest. Respect the possibility of violent whip around, even if the thesis is correct. Decide your invalidation level, decide your sizing, decide your time horizon, then let the market show you whether the structure is holding. Because if global liquidity really is shifting, and the evidence says it is, then gold and silver aren't just going up. They're being used. They're being chosen. They're being pulled into the role of shock absorber for a system that doesn't fully trust itself right now. And that's why the next leg, if it comes, won't feel like a normal rally. It will feel like the market suddenly realizing it has to pay up for certainty. One last thing before we close. If you're still here, you're not looking for hype. You're looking for edge. The edge isn't secret news. It's disciplined interpretation of mechanics. It's being the person who understands why a 3% silver drop can be a bullish signal if it S flushing leverage while physical and structural signals stay tight. It's being the person who doesn't get played by the volatility theater. So here's the identity CTA, and it's not begging. If you're building a serious macro metal framework, stay close to people who respect mechanisms over memes. Compare notes, share what you're seeing in spreads and premiums and structure, not to follow a crowd, but to keep yourself honest. In a market like this, community is a risk management tool. Next week, come back to the checklist. Gold behavior at $4,600, silver behavior at $90, curve and spread firmness, signs of margin-driven liquidation versus organic selling, and whether dips are being absorbed or rejected. If gold holds structure and silver reclaims the psychological line, the pressure remains in the system. If those levels break and the structural signals relax, you shift from squeeze posture to consolidation posture. Either way, you don't panic, you don't chase, you execute. Because the move isn't a story, it's a system.